Hello, hello. Well, good morning, good evening, good afternoon, wherever you are. Well, good morning, good evening, and good afternoon, wherever you are. Well, today I shall be speaking about financial reporting. Well, financial reporting involves communicating relevant, useful financial information to users of financial statements. And if we are to look at the users of financial statements, of course, the government itself. The government uses financial information in order to assist the performance of businesses in the economy and also to assist tax. So, in other words, if we are to look at the users, the government itself for tax purposes and also the economy as a whole. So, tax assessment and the performance of the economy as a whole, sector-wise, yeah, and as the economy. And also, this kind of information helps the government to take decisions on which sectors to invest in, which sectors are lagging behind. How about the shareholders? Shareholders are owners of the business. Shareholders rely on financial information in order to hold managers and directors accountable. The law of agency uh, uh, defines directors and the executives as agents of shareholders or the owners of the business. So there's a separation between ownership and management. So the shareholders themselves, they will rely on financial information being published in statement of financial position, statements of profit and loss and other comprehensive income to hold managers to account. How about employees? Employees are much concerned about their job security. Looking at the financial information wherever you're working or your company, you can be able to to compare or to predict the continuous existence of your company. So, as employees, we're all looking at continuous employment or the continuing existence of the companies. How about lenders? A lender will only be concerned about uh, the business existence, the performance of the business to determine its liquidity, its solvency in order to pay off its debts. As a lender, as a bank, as a supplier, you be much be concerned about the performance of the company to see that it will be able to to pay you off before it goes bust. So let's talk about solvency or liquidity, whatever. In order for information to be useful, in order for information to be useful, it should be relevant in the sense that relevant information, financial information, should be predictive, predictive, or it should confirm. It should be predictive in the sense that you can use it to forecast the future. Uh, you can use it to make decisions. In order, it should confirm, it should conform, it should be confirmatory, it should confirm, uh, it should conform to really what the user is hoping for the future to be. Faithful presentation. Faithful presentation looks at complete information, the neutrality, complete information. Information should be complete. If information is given partially or is incomplete, it can influence the decisions of the users. Take an example. If I want to invest in a company and I'm given less information about your performance, well, I can take an ill-informed decision about where to invest. So, faithful presentation requires information in financial statements to be complete and neutral in the sense that you should not be biased as preparers of financial information. You should not be selective of which information to disclose in financial statements. Uh, Other than information being relevant and being faithfully presented, information should be consistent. Well, these are called enhancing qualitative characteristics of financial information. Consistency in the sense that treatment of items in financial statements should be treated in the same way year after year. Changes should only be made if making changes will enhance the way the reporting of financial information is done by the company. So consistency calls for treatment and use of accounting principles. Yeah. So the accounting policies determine how items should be treated. So consistency calls for treatment of items in a similar manner, could be year after year or in the same accounting period. How about comparability? Comparability looks at the ability to derive similarity and differences in financial statements. Say um, year zero one, year one and year two. So if we are to make comparison, relevant information we should be able to help us derive the similarities and the differences within the financial statements, or the differences similarities should be uh, derived from company A and the company B, provided they are operating within the same industry. So comparability should help us to see the similarities and differences. How about understandability? Relevant information will be easily understandable. This doesn't mean that you have to leave out information that is complicated, that users will find complex. So information should be disclosed in a simple manner and an understandable manner. Timeliness. Uh, we all know that information to be relevant, to be useful, it should be reported on a timely basis, since reporting information in a non-timely manner will affect the decisions that we make. So this brings a trade-off between timeliness and completeness. Completeness. So it's it's not relevant or it's not useful to publish complete information at a later stage when we need to make decisions to date. Well, what completeness will be, or what completeness will bring, is to make decisions that are informed. Well, um, it's better publishing less information on a timely basis rather than publishing a lot of information at a later stage. So there's a trade-off between completeness and timeliness. Verifiability, that is pretty easy, stayed easy. We shall not go much into that. Let's look about the conceptual framework in accounting. Conceptual framework is like kind of guiding principles, a body of guiding principles that are used by preparers of financial information. Yeah. So the conceptual framework exists in order to help preparers of financial information to define what the items, what the items, what the items financial in the financial statements are. It will help. It will help us in order to review and make new accounting standards, as we shall be looking more in future about accounting standards. Accounting standards are derived from the conceptual framework. So with the existence of the conceptual framework, it will be very easy to come up with different standards, and also see how different items and events are being reported in financial statements. So the conceptual framework helps us to make my handwriting is not that good. make, amend, yeah, make, amend, standards, accounting standards, yeah. It will help us also, yeah, well, scrap off, amend, treatment of items, treatment of items in financial statements. Well, we all know that I wish every one of you guys has ever seen this. So, the conceptual framework defines an asset as a resource controlled by an entity as a result of past events. Well, the core word here is control. Control comes with rewards and risks. Yeah. If a company or an entity is able to enjoy substantially all the rewards that come with an asset or a resource that come with the resource, and is exposed to the risks that come with it, then it controls the asset. Yeah, it controls the resource. Definitely, this one becomes an asset. So control comes with rewards and risks. So an asset is a resource controlled by an entity as a result of past events. So rewards and risks should be incorporated for a resource to be an asset. Liability. Who knows what a liability is? We all hear about a company or someone being liable, but when it comes to liability of a company looks at an obligation. If a company is having a current obligation to transfer or to pay someone or to transfer a resource from its pool of assets to another company, that obligation is a liability, and this kind of obligation should not be avoidable. Yeah, the core word here is obligation. An obligation for an entity to transfer a resource to another entity. It should not be revocable. It should not be revocable. It should not be revocable. So, well, it should not be inevitable. It should not be inevitable for a company. It should not be inevitable for an entity. Yeah, or it should not be avoidable. Not avoidable. It should not be avoidable for a company to transfer any resource from its pool of asset to another. So if that happens, that there's a possibility of an entity to revoke or not to transfer a resource to another entity, then that's not a liability. A liability should be an obligation, or it should be required by all means for the entity to transfer a resource to another. A going concern. Well, this is also pretty easy. Going concern. It is assuming that the company will continue operating for a foreseeable period of time. Well, and if there are some circumstances that are rendering the company or they're threatening the future existence of a company, those should be reported or disclosed in financial statements. So, going concern as one of the core areas, as we shall be seeing in future, is concerned about the continuous performance of the entity for a foreseeable period of time. Substance over form. Substance over form looks at the fact that well, events should reflect the economic reality rather than the legality. Yeah. Well, take an example. If you sell an item, or if you sell an asset to another entity, then lease it back, yeah, at a cost that is equal to the amount that you sold it. That is, if you have to look at it, the economic reality is like you buying the product back. Yeah, you're leasing it back. You sold it off, but you're leasing it back. yeah, at an amount that is equivalent or substantially equivalent to the amount that you sold it. This calls for an asset to be reported on 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 the balance sheet as an asset and depreciated over its useful period of time. Well, we shall be looking um, about the same or more of the same in future. Substance over form, business entity model. The affairs of the owners of the businesses should be separate.